Alright, so I wanted to go over someone's question they asked, and more so kind of a statement they made. And I'm only making this video just because it brings up a really good point, and it's something that happens a lot in trading range environments. So, and I just scribbled the person's, I scribbled this stuff out just because I didn't ask them, if I could do this, and just kind of out of respect to this particular person. But so let's get into it. So he says there was a bearish trend on the 29th at around 1920. So it's probably around here. This sell-off right here, which is followed by a bull channel for almost 10 hours. So this right here, and he probably sees it kind of like that, I guess. You can call it that if you want. It really, I don't really pay much attention to that part exactly. And he says during this time, I was in doubt if the channel could be a bull flag. Could be a bull flag for the bear trend. Okay, I think he means a bear flag for the bear trend. I was in doubt if the channel could be a bull flag for the bear trend or might turn up and form a trading range. Yeah, okay, so what he meant to say, he or she meant to say, I was in doubt if the channel could be I kind of think, I guess he means bull flag, but anyways, let's just kind of skip over that. Or might turn up to a leg and form a trading range or range. However, at 5:55 a.m., probably, 5:55, maybe right there. Oh, okay, so it's just his time's a little off. His or her time's a little off, or mine is. But yeah, there's really strong bull breakout, So his question is, so this person was wondering if it was predictable so that I could put a buy order anywhere before the spike and take profit on the high. Well, yes and no. First thing is, okay, so let's just pop up a 1 minute chart. Here's what this person's talking about. I think, let me double check. Yeah, so it's about 10:05 my time. Yeah, okay. Well, yeah, so here's a 1 minute chart. And what do you see right here? This is, you're getting big moves, big pullbacks, sell off, deep pullback, deep, big moves up and down. And all of a sudden you're getting this really, really tight channel. Let's look at the 3 minute chart. Again, same thing. 1, 2, 3, 4, 5, 6, 7, 8 consecutive bull bars. Bull bars. The character of the market's changing. 4 minute chart. 1, 2, 3, 4, 5 bull bars. If you notice, look at every close. Traders are buying. They're not even trying to sell to buy the prior close. They're just, they're not even trying to use limit orders. They're just, hitting buy the market. And I understand market's a limit order, but what I mean is they're not looking and saying, okay, this close is 13.32, so I'm going to buy the next bar at 13.32. No, they're just hitting buy the market. And so yeah, I don't need a smaller time frame to see that. I can look and tell, look right here. Look at this whole move. Okay? After it's over here. So we're getting bull breakout, bad follow through, bull breakout, bad follow through, bull breakout, doji, bear breakout, doji, bear bar, bull bar, bear bars, more bull bars, two-legged pullback, sell off, bad follow through, sell off. So look, bulls are making money buying below bars. 37 to 22, so they could have bought this low, bought more, got out. They're making money. And the issue you always have to wonder is, okay, This is going to sound kind of crazy, but traders will do it. Yep. So, you know, this was a surprise. Very often the market will, usually it'll let you out without a loss if you do the right thing and manage your trade. However, for the record, you know, if I bought this low and I see bear bar, another bear bar, another bear bar, I'm getting out probably on this bar. If I don't, I'm no question going to be out I'm going to exit this bar. No question. And I'm going to try my best to get short. It's a breakout, you know. However, plenty of traders will buy this low right here, and they will wait for a bull bar. Okay? So let's say you bought above here. Well, a couple things. So let's real quick do this math. A lot of times traders will do this, and I don't know if it's going to work here, but we're going to see. So 114.0, we'll just say 06. And by the way, TradeStation, it's set to where, you know, the 114.10, the 9, I guess it's called a micro pip, or a, that's what I call it, and it's a fraction of a pip. I guess that's the proper term. So it's 114.10 pips. So the pip's kind of like a, you know, a cent, if you will. So it's 10 pips. So if, you know, if right now we're at 14.1, if we go to 14.0, that's 10 pips. Hope that makes sense. So yeah, so real quick, let's look at that. Okay, so 114.06, already got that. Let's say we bought one lot up here, and we buy 2 lots up here at 113.28. And we doubled our position. Okay, so 1354. Well, not quite, but very close. So, you know, but again, probably a minor reversal. So I think it's certainly way more reasonable. You know, if you're gonna hold through something like this, you know, there's probably going to be a bigger second leg down right here. So you're probably not going to buy above this bar and hold. And, you know, you obviously could have gotten out break even, you know, just to clarify. You could easily get out of break even over here. But I think more traders will buy above this bar. And you can see break even bulls who buy this low bought more, avoided a loss. And, you know, that's how major trend reversals work. You get a sell off, deep pullback, and you have a lot of bears who are, number one, they're disappointed. They're disappointed by this bad follow through. And if they sold down here at this close, they're going to want out around break even. Well, they're going to do the same thing. So they're going to wait to sell below bull bar, or bear bar in this case, excuse me. You know, do they sell? We'll start with this. Say they sell below here. Well, they got out of break even. If they sold below here, got out break even. Say they sold below here, got out break even. What about way up here, this really small bar? Well, you can see what happened. This kind of happens a lot in my opinion. Gave them a chance to get out break even, gave it a chance to get out break even. If the bulls didn't take it, it sold off, and some bulls may have thought, well, gee, I'll wait and see if we test down here. Well, they did that, and they had to be, you know, they probably were not quick enough to get out without a loss. Then they had to, you know, they had to sell at a higher price, and bulls aren't stupid. They know this, and they had to chase the market up. But you don't have to know any of that to understand what's going on. Ultimately, trading range, bulls made money. They buy this low, buy more somewhere way down here, make money. But you don't have to know any of that. You know, just take always in. You know, always in is extremely important, and the reason for that is it can help you stay on the base. You know, I think it should be the basis of most people's trading because it leads to, you have to know the swing direction in order to really do anything in the market. Well, I say that it really helps. I'll keep it with that. So, sorry. So, anyways, yeah. So let's just look at always then. Just start down here. Bulls buy back, bears buy back their shorts. Do they go long here? I don't know. Maybe. Arguably a bear breakout below a channel. Maybe they go long. Maybe they, if they do, you know, bears get out. Maybe bulls go long. Where do they go get short again? Well, do they sell here? I don't know. Kind of below the moving average. You have to expect, spike and channel down. Maybe we'll test up to this high, top of the channel, climactic sell off. So maybe we'll get, two legs sideways to up. So maybe this is one leg. And then what about up here? What do the bears do? Do they get out? Well, I don't know. This is a fairly tight channel. And, you got to think there may be buyers at this moving average, and it's only about 5 pips away. So it's really not that far. The bears really don't have a lot to work with in order to make a scale. These pullbacks are only not even 10 pips. And then, we got the bull breakout. Second leg up likely. Did the bears get out here? They might. I think others get out around here. But, if they do, wedge bottom, they probably don't buy here, but here they've got to probably get long again. And then, what do? They get out here? Well, maybe, but probably not. What about here? Well, maybe, but again, probably not. But you have to be aware of top trading range. So it's a place where bears probably want to take profits, and gaps have been closing. So, where bulls want to take profits. So maybe they don't get out here, but then again, you get, kind of an IOI, second entry short. I think a lot of bears will get out below that. I think a lot of bulls will. If they don't, they get out here or here. And, at some point, it becomes clearly always in the short. And bears will sell, stop up here. No reason to get out, no reason, still no reason. A lot of bulls will, some bulls will get out here, and other bulls will sell and scalp. But the reality is a lot of bears know this is one of those really very high probability moments if you understand what's going on. So it's less reasonable to buy above here, but it's reasonable if you buy and use a wide stop. So maybe you, I don't know, maybe you just sell and put a stop. I don't want to sound too crazy, just you sell and use a really wide stop, and you buy more lower. You buy above this bar, use really wide stop, buy more lower, and you'll probably make money. Now, what's buying more lower? It's not buying here and buying here. It's two things. It's either buying this high, so your entry's at 13 or 113.34. And you buy, 10, 20 cents lower and scalp out, or you wait for a bull bar. If you wait for a bull bar, you don't buy here, you buy lower. It's better if you buy above this bar, second entry buy. So I think a lot of always in short bears will get out above this bar. But if they do, strictly speaking, they got to get short again. And they definitely get out above here because we're probably going to test both of these stop entries. So that's where high probability comes. If you don't take these, and you buy here, you've got a very good chance of making the price getting back to these highs. So kind of a side note for you. So kind of like this, okay? Buy above here, stop somewhere down here, betting that we get back to this high, this high, or this high. It's really high probability. Anyways, that probably bears get out. We're probably back to always in long briefly, but we'll probably find sellers at the moving average. So do bears get out here, or do bears get out? Do bulls get out, bears get in? And I don't know, probably not. Probably second leg up likely. What about here? Tight trading range. They can, but probably wait for the next day, or since it's Forex, they probably just hold, and in theory, they think second leg up. Well, now we have a second leg up, strong enough breakout, maybe a second leg up from this breakout. So bears either get out here or here. I think they get out during this bar, and I'm sorry, bulls get out within that place. Bears go short, but then what do they do here? Do they get out above here? Second entry buy, maybe. I think they certainly get out here. Bulls probably go long, but then again, not very strong, failing at the moving average. You've got to think we may test down here, so they probably get out below here. Bears have to get short again somewhere in here, but once you get down to here, again, what do you expect? You expect buyers, so really not that simple. And then, on a side note, I want to point something out. I have to just kind of scroll to show it. This also happens a lot. Bears sell this close, they sell more at this high, try to get out of break even. I don't know if it would have worked on this, but probably wouldn't. Yet a lot of bears do that. But yeah, so at some point, I think a lot of always in bears get out here. 3 pushes down. Where do bulls buy? Bulls can buy above here. They can buy here, or they buy here, or they buy this close. So it's always in long. Clearly at this point, stop down here. Still always in long, and then we just skyrocket up. You got to think about it. Think about 2 ways. Think about it in terms of risk. I don't want to go into that. So your stop's down here, and on this close you're risking 113.41 to 113.18. That's like somewhere between a little less than 30 ticks, 30 pips. Somewhere between 20 and 30 pips. And then you get this bar. Well, ask yourself this. Where's your stop go? If you're going to hold long up here, well, at a minimum, it's all the way down here. From this close at 1402 to this low, that's 60 pips. Well, another thing, that's a likely target. So what is your goal if you put it a different way? I'm going to have to zoom out to do this, or else I wouldn't, just kind of make it more clear. But yeah, so if you buy, put your stop down here, you need to measure move up to here. Well, if the risk is bad, stop all the way down here, possible trading range. Okay to stay long, but I think you got to get out below this bar because too much risk in the second leg trap. Trading range days, you always get big bars that rocket up to the top with that follow through, and it'd have been different. If this would have been a bull bar and the next bar big bull bar, different story. Probably had a really big day, but we got a bad follow through. So a lot of always in bears, always in bulls get out. Bears go short, or bears sell above here. You have a high one short after a clear buy climax. First target is here. But yeah, well, real quick, I want to go back to the 1 minute chart. You could have bought. You buy this close, 2204. Well, if you bought at the market, you'd be in at about 1371, so maybe 72, 73. You could have gotten out at least with 30 cents. You could have gotten out, even if you did that. Could have gotten out even below here with about 10 cents of profit. So another thing, again, buy the close, bulls buy here, they buy more lower, and they try to get out at break even. Same thing happened right here. So that's the dangers of, that's why you don't hold short below this bar. So always in short, probably below here. I say that because it's still always in long, but bulls will get out, bears will. Aggressive bears sell, no real reason to get out. And and then we just keep going down and down and down and down, and then always, bulls get out. Bears get out, bulls go long. But then again, trading range day, you can see that traders who bought here, bought more lower, avoided a loss. So I hope this helps. And my whole point behind this is you can never guess of course, is it possible to predict the size of this bar? No, it's not possible. But I say that just because that doesn't really matter to me. What matters is consecutive bull bars, always in long, I need to buy. When we get this, there's no way. If I buy at this close at 13.44, by the time we get to here, I'm at 14. I've made 60 pips in a market and when the range right here is 40 pips. I made 60 pips in less than 5 minutes. Or in 5 minutes. So you have to think it's a gift and you get out. So I hope this finds value in some way, and please comment if you have a question. Thank you.